Stocks and risk assets in general have the setups in place for this corrective activity to accelerate to the downside. There is historical precedent and some reason to believe that we may get a bounce that could last 1 to 2 days or maybe even 1 to 3 weeks. But the setups are very concerning and they need to be respected. We'll kick off this video reviewing some recent calls that we've made using the Shivako Capital Management proprietary market models. We do so from a confidence perspective. If you know your models are working well and your analysis is sound, you'll have more confidence to be able to pull the trigger when you need to. And anyone that's managed money before or traded knows that protecting your confidence is probably the most important thing. We'll go over quickly S&P 500 support. We'll focus most of our time on what to watch for bullish scenarios and bearish scenarios. We'll look at weekly RSI and spend the vast majority of our time on a risk-on, risk-off chart and table. We don't have time to cover DeMark today, but we will say that the DeMark counts match up with what the technicals are telling us, that we should be concerned here, but we haven't seen enough just yet to overreact. That could happen next week. Our approach and the purpose of our models is to pay attention. You have to monitor the temperature gauge in your car. We will continue to monitor the models and markets with an open mind. Since things can change quickly, especially when you get announcements from Europe, we'll try to provide updates and our thoughts on Twitter. You can find us by Googling this. You don't need to be on Twitter or know anything about Twitter to read our comments. We spend a lot of time prepping for these videos. If you can help us spread the word and retweet or post links, we really appreciate that. One last comment before we push forward. I like to say that our models and the tape say what they say until they don't say it anymore, which means we need to be extremely flexible and open-minded. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the S&P 500. We've got a lot of ground to cover. 1 point. Possible support levels you might want to jot down. If you want to look at this, pause it. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. As you can see, for the most part, this helps capture the trends. The point right now is blue has just ducked below red. We also, the models monitor the slopes of these lines. So some of the thresholds are, is the slope up? Is the slope up? Is blue above red? Those are the 3 questions that the models ask on this chart. And as you can see, we're moving towards negative territory here. And it's important that blue was below red at the end of last week because it did get a weekly close. So this chart is also saying be careful and things could get worse and we may take some defensive action and raise some more cash even though we already have a very high cash position. This video covers some potentially bullish developments pointing towards a rally attempt or bottoming process in risk assets occurring sometime between late May and early June 2012. We would expect, if the pattern holds, that we would reach this line somewhere between October 10th of this year and October 19th. This is a chart we've covered in the past. Go through it very quickly here. 1 point. Weekly chart, S&P 500 tends to be red flag below RSI of 56 and positive when RSI on this chart is above 56. We closed above 56 at 58 on Friday, October 19th. Just something you can monitor. This chart looks very noisy and complex, very easy to understand. It's basically just simple support and resistance. We'll go through it piece by piece. We're going to spend the majority of our time on this chart since we believe using this chart you can't go too far wrong relative to risk-reward trends in the market. This is a weekly chart of the S&P 500 index divided by long-term treasuries, or the TLT ETF. This is the ratio. When the ratio is rising, stocks are in favor relative to bonds. This is what risk on looks like. This is what risk off looks like. Here is the S&P 500 on a weekly basis as a comparison. I said this was basically support and resistance. These are resistance lines here, parallel resistance lines for the ratio. So this is resistance for risk on. When you hit resistance for risk on, the stock market on a weekly basis tended to do poorly. Resistance, stock struggle. Resistance, stock struggle. Struggle, struggle, struggle. This is another resistance point. These are parallel trend lines, these purple lines. We hit here, stocks did poorly. Here we plowed right through it, but this is a parallel version of this purple line. Acted as resistance, stocks were peaking, didn't do well after that point. Conversely, when you're at support, this was resistance, stocks did poorly. This is support, stocks did well following that. It's another form of support. These are parallel trend lines here, but notice these are downward sloping. This might be significant. These purple trend lines are upward sloping. That tends to be bullish. If you're a bull, you want this purple trend line to hold if we have weakness. If we can break out above this purple trend line, that becomes extremely bullish. Where we are now, we're at resistance, obviously. So the point of this whole exercise is when you're at support, stocks tend to do well. When you're at resistance, stocks tend to do poorly. Right now, as you can see, we are at resistance, which tells you that your risk-reward is shaky here. Now, if we can break through and move to this side, you'll notice this green arrow here. I'm saying if you're above this resistance, that's the promised land for the bulls. Why is that? Because in my mind, that signals a permanent change in market sentiment from longer-term risk off to risk on. And how do I know that? This is where the European debt crisis starts to accelerate in 2011, and the market, for the most part, becomes bounded and ruled by risk off. This is obviously a downward sloping bearish trend line for risk. What we have here is a change in market sentiment. In October of 2011, relative to this period here in the spring of 2012, this is a higher low. This is now an upward sloping trend line, which would be bullish for stocks longer term. When we were at this purple trend line, we made it all the way to this parallel trend line. Then we came back down to it. So what does that tell you? It tells you that the market believes that these two trend lines are important. Wow. If we fail, notice we were here, we moved to the top purple trend line. We had a correction. This is risk off. We went back to the same trend line. Now, if we can't get back to this trend line and we correct from here, that's a bad sign. So if you're a bull, what you'd like to see happen, at a minimum, you'd like to see us make it back to this purple trend line. And then if we correct, you'd like to come back down here. That would keep the bullish trend intact. If you're a bear, or you want to be bullish on bonds, you would like this to be your relevant trend line. So now we moved from here to here, the red trend lines, from the top red trend line to the bottom red trend line, back to the top red trend line. If we come back all the way to here, that's bearish. Notice the slopes of the red lines are pointing downward. So we can learn a lot here based upon where this ratio goes. In the short run, obviously, this is a lot of resistance here for risk on. Why would you exercise any patience here? Well, it's possible because you've got a higher low here. This is bullish that we're going to make it to this point. That would also represent a clear breakout from this downward sloping set of blue trend lines here. These are parallel blue trend lines. This is why this is the promised land for the bulls. In my mind, if we can get into this area, and more so even into this area here, it signals that the European debt crisis in terms of the short term is probably behind us, and it probably says that these upward sloping trend lines will dictate where we go from here. Conversely, the promised land for the bears, step one is to make it to this trend line. We'll probably bounce here, but it probably says there's lower lows ahead in stocks and higher highs ahead in bonds. The real promised land for the bears is if you break this trend line and get into this area, that would be extremely negative for risk on and extremely bullish for risk off or bonds. In terms of managing risk and reward in the short run, if this ratio moves into this white space here, we probably start to look more like the corrective period in stocks. This is the S&P 500 here. There's a peaking process that we'll refer to between April 1st, 2012 and May 1st, 2012. After May 1st, the stock market accelerated to the downside and lost roughly 100 to 108 points on the S&P 500 from this point here to this point here. If this ratio breaks into this area here, it's negative for the stock market and bullish for bonds. However, there is some support here, and potentially even this support line is still in play. We're trying to recapture it. This is support for risk, support for risk. Till we get some resolution in this mess here, then we really don't want to make huge commitments one way or another. If we move here, we become even more defensive. If we hold this, we become neutral somewhat in the short term. If we break into this area here, we probably cover our hedges, redeploy some of our cash into long positions. Again, this is the S&P 500 weekly here. This is hard to see, but this is just a rough sketch of Fibonacci retracement levels. What it tells you is from this move here, from the summer lows to the recent highs, these are rough numbers. Just under 1,400 is the 61.8% retracement of this move from here to here. The 50% retracement level comes in somewhere around 1370 to 1378-ish. Notice you also have stock market resistance with this dotted line here, and I've also got an upward sloping trend line for the S&P 500. Support, support. Dotted line, solid line, Fibonacci's all seem to come into play somewhere in this area here. Let's call it 1360 to 1386, because if the market takes some time to come down here, it will meet this rising trend line, so it would actually be higher than this point where you would meet. Now we're going to scroll down and look at some indicators. The indicators can help us draw bull and bear demarcation lines in the sand. Now, what we care about is this. This is S&P 500 weekly right here. This is the peaking process. This is what a market looks like when it's running low on upside momentum, or upside momentum is waning, or downside momentum is picking up steam in this area here. The market began its peaking process roughly around March 1st of 2012, and the acceleration, in my mind, to the downside starts in this red box here, which is late April, early May. So this is the area that we're really concerned about. As long as you're in this blue box here, things aren't that bad. When you migrate over to the red box, ugly. This is where you want to be in cash, in bonds, short, hedged, on the sidelines. Here is where you want to exercise some patience. So, where's the bull-bear demarcation line? This is the relative strength index. Now, this is RSI for the ratio of the S&P 500 to bonds. This is not RSI for the S&P 500. RSI for the ratio. As long as RSI held above 50 on this weekly chart, and this is a weekly chart, the market hung in there. But on a closing basis here in mid to late April, when we broke 50, that was a red flag about this potential acceleration in the stock market where I am now to the downside. So what we don't want to see RSI close below 50 on a weekly basis on this chart. The weekly close is important because you can get head fakes on a Tuesday or a Wednesday, and then the market recovers and closes above it. So a weekly close is where you get the highest probability of getting a good signal and minimizing the probability of a whipsaw. You can see as of the close on Friday, we're at 53. So we're not in panic mode here, and you have to admit that this looks like RSI is trying to hold here. Let's go down to Williams percent R. I'll scroll down just a little bit here. Williams percent R is momentum. We're going to go to a table in a minute that will show you exactly how far the market fell, what to write down potentially, what to look for. This says think in probabilities. We always want to think in probabilities. So whatever we say here, if RSI closes below 50 on a weekly basis, does that mean go 100% short, mortgage the house, and bet everything on the bearish case? Absolutely not. All it means is that the probability of further declines, the probabilities are increasing for the bearish case. Every threshold that you cross, the odds of bearish outcomes increase. The market can do whatever it wants, whenever it wants, but if we think in probabilities, we can align ourselves relative to risk-reward in a more favorable manner and control risk while we're doing that. Williams percent R drops below 50. Notice when it drops below 50 on a closing basis, we're still in the blue box. This is part of the peaking process. This is the S&P 500 at the top where the cursor is. Where the acceleration started is when you broke below here, which in this case was negative 57. Is there anything particularly magical about negative 57? No, there's not, but it's just another hurdle that would say if you get a weekly close below negative 57 on Williams percent R for this weekly ratio chart, the odds of downside acceleration in the stock market increase. Rate of change, this is rate of change for the ratio of the S&P 500 divided by TLT, long-term treasuries. Rate of change here drops below 3.75%. That's when the acceleration in the S&P 500 started. Notice where we are now. Closed Friday at 8.44, which if I come across here, looks more like this period here, which is part of the peaking process. Have to point out, even during the peaking process here, the S&P 500 rallied for 2 to 3 weeks here, which says as of the close on Friday, even if the odds are favoring lower lows, it doesn't mean a counter trend rally of some significance or a head fake can't come into play. Again, we'll note these levels in a table in the next slide. The Kopic curve, when it's sloping upward, that tends to be a market that's bullish. When it gets flat, that's indecision. When it rolls over, that's bearish. You'll notice during the peaking process, the Kopic curve started to roll over. It had already rolled over and already looked bearish for the ratio when the downside acceleration here in the S&P 500 started at the top. The current Kopic curve, like rate of change and like RSI, looks like it's trying to hang in there. So we have to keep an open mind about where we are right now. I think the odds favor lower lows, but these indicators are telling you not to run for the exits yet. Scrolling down a little bit further here, this is MACD on a weekly chart for the ratio. Point of the exercise here, if you wait for a weekly close on MACD, it's a pretty good signal, gives it to you decent point, but it can be a little bit late. These signals tend to come a little bit earlier. Now, let's go to a table and see what to look for to differentiate between the blue box, which is a peaking process that could actually go higher, and the acceleration to the downside. This table looks a little confusing, easy to understand as we walk through it. These are the bearish thresholds, so what we did, we looked at the last correction. When did RSI on a weekly chart for this ratio drop below? Intra-week, it happened on April 10th. Look how early that is. That's really 3 weeks before the real acceleration started to the downside. This was a yellow flag. What this means is RSI dropped below 50 during the week, but then at the end of this week it closed above. Here it tells you that on May 4th, Friday, May 4th, was the first time RSI closed below 50 on this weekly chart in terms of a weekly close. How good were these signals? So RSI dropped below 50 on May 4th was the first time. What did the stock market do after Friday, May 4th? On May 4th, the stock market, or S&P 500, closed at 1369. The intraday low was over 100 points lower at 1266. So what it tells you is this signal of RSI closing below 50 on a weekly chart was a good signal in that the stock market fell 7.5% after that. The red values here, so May 2nd, tend to be the better ones. This one here on April 10th was just an intra-week move of RSI 50. It was a little early, and it only saved you 6.7%. The May 2nd signals intra-week were Williams percent R dropped below negative 57 intra-week, and your rate of change intra-week went below 3.75%. How good were those intra-week signals or red flags? Very good. After May 2nd, the S&P 500 moved from 1402 on May 2nd to 1266, and it dropped 9.7%. Point of the exercise. The biggest thresholds, closing basis, if RSI on this chart closes below 50, red flag. Williams percent R moves intra-week below, red flag. Closes below negative 57, red flag. Rate of change, intra-week moves below it, red flag. Get a close below it, even worse, red flag. So here are the things to look for going forward in terms of probabilities. So the more bearish thresholds that are crossed here, the higher the probability of further downside. The good news is, as of the close on October 20th, despite all the weakness we have, none of these are true. RSI closed above 50 last week, Williams percent R above these levels, the rate of change is above this level, and we do not have a bearish MACD cross. Now, if the analogy holds from the last correction, almost every single one of these things would happen by the end of next week. If that doesn't happen, it's bullish in some ways. It tells you to keep an open mind and that the pattern may be broken. Maybe this market will surprise on the upside. We'll go into next week with a mixed/defensive position. We're net long, we have a lot of cash, and we have hedges. We'll either migrate to a bullish stance based upon what happens or to more of a bearish stance depending on what happens. We'll keep a flexible and open mind and think in probabilities. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.